of real estate investment trusts. This week, we are going to uncover for you which are the REITs that are diamonds in the making. As you know, diamonds are forever. So, are there REITs, therefore, that you should have forever in your portfolio? Or should you be trading them out as and when? Now, the intrinsic qualities of diamonds is durability as well as of value. Are there, therefore, durable and value REITs that you should be looking for in your REITs portfolio? At the same time, ladies and gentlemen, in this week's video, we are going to talk about another kind of REITs that are the dud REITs. These are the dud REITs that you should avoid by all means in your portfolio. Dud REITs, as defined by the Oxford Dictionary, will not be are the ones that actually fail to deliver up to a certain standards. Therefore, if REITs are basically classified as income producers for passive investors like retirees, like you and yourself and myself, then have these REITs actually met their requirement. But before we address the key points for this week, let's look through what are the key things that I want to be covering. Now, before we go into diamonds versus dud REITs, yes, both are Ds, so to speak. One's for diamond, one's for dud. What can we learn really about the past S-REITs recovery? Now, we have had basically two down cycle of the REIT market because of upcycle interest rates previously. That was in summer of 2004 to 2006. And the second one was between in 2018, where we have series of interest rates increases culminating at the peak on 20th of March. Now, how different now the recovery then compared to the recovery now? After all, some investors are getting a little bit jittery because in the last 2 weeks, S-REITs have just moved flat and sideways, which we will show you. And then, of course, we will actually look at which are the REITs that are potentially duds that you should be looking to avoid. Now, in previous series, in previous videos, and for those who've attended our GCP Global quarterly classes, you notice this is our 21st year of teaching global REITs. You'll notice that essentially we have highlighted a few things. One is that recoveries will never be straightforward. As you can see, this is a FTSE index uh, chart, going back into the downturn in 2018, where you can see, ladies and gentlemen, that in the end, the down cycle lasted for 10 months with the Dow, with FTSE index down 112 points or in total 13%. And that's why in this basically recovery, in this particularly sell-off, this time around, where we told you that the sell down was already overextended, it has always been based on a firm understanding of history and whether and to what extent history repeats itself. Now, more importantly, ladies and gentlemen, when the recovery came, that was actually in the beginning of 2019, after the Federal Reserve peaked its interest rates on the 20th of December 2018. You notice that essentially after an initial run-up in the REIT index, and therefore REITs, you can see that you actually have a series of pauses, as you can see from the chart in the second half of it, throughout 2019. You actually have 1, 2, 3, 4, 5, 6, 7, 8. 8 pauses before the index reach higher as enumerated by the pink arrows. But in total, ladies and gentlemen, right up to the COVID sell-off on 19th of February 2020, the FTSE index climbed a total of 210 points or up a whopping 28%. Now, will this time be different, ladies and gentlemen? You'll be asking. Now, this, ladies and gentlemen, is the S-REIT, or rather the IHS REIT index. You can see, ladies and gentlemen, that right now, as seen by the yellow portion, for the last 2 weeks going into the new year 2024, you can see that essentially it has just gone flat, and therefore it has really led to some skeptics questioning whether the S-REIT rally that we talk about is likely to fizzle out. But before that, ladies and gentlemen, let's look at what we told you and guide you 4 months ago. Now, this was actually our YouTube video entitled REITs at the Crossroad and What Lies Ahead. In the video that was filmed 4 months ago, that was actually at the bottom in September, we actually highlighted a few points that REITs essentially has actually crossed 24 months in terms of, or rather 24% in terms of sell-off. This is by far the largest sell-off in terms of magnitude. Two, the length of time. At that time, it was 20 months. It's by far the longest sell-off. As you can see, the 2018 sell-off, in contrast, only lasted 10 months. So that was the basis of us calling the bottom. And notice that, ladies and gentlemen, when we call bottom, we do not basically, tells it in a whimsical. We went on air. This is actually a my interview with Channel News Asia, where we told you that October would be the low. And indeed, October was the low for the FTSE market. Now, we also went on and were privileged to be invited by the Business Times for their half-hour podcast. The gentleman in green is actually none other than senior correspondent Mr. Leslie Yu, which actually interviewed us for half an hour to go through all the key dynamics of the REIT market. And again, we clearly stated that recovery was much in sight. And moving on, this is again our video that was filmed 3 months ago. That is basically in October when the market finally hit bottom, right? And we did say that that video, new low for S-REITs and what's up for fourth quarter. And if you do look at our video, and I strongly urge you to do that, you notice that how we managed to pick the bottoms was based on a very scientific way, based on the past precedents, and based on a past historical understanding of markets and how REITs perform, not only in the Singapore market, but because we cover diversified REITs and global REITs in our 35 years of public teaching, you notice we were able to actually catch the bottom simply because of the knowledge that we have, the in-depth analysis that we offer to GCP global investors when they attend our class. And of course, for those of you who want to know about REITs and how strong this recovery going to be, do attend our next class that's coming up on the 23rd of March. And you can sign up on here or at GCP Global website. It will be held at Suntec REIT and rather at Suntec Convention Hall. And it's entitled Picking Winning REITs as Interest Rates Drop. Yes, ladies and gentlemen, this item or this title was coined last year, before interest rates was even speaking of any possible drops. And you can see that we have the foresight to be able to enable that REITs, the first interest rates probability of dropping could be as soon as March. But our own base case analysis is likely to come in only in April or May. But nonetheless, we are into an era where interest rates will start to drop. So essentially, in the recovery, that means from the bottom that we actually spotted for you and enunciated both in our YouTube as well as our Channel News Asia interview, as well as in our BT podcast interview, what have happened. Now, look at the first table. This presents the first 10 REITs from Capital Mall Trust, Ascendus REIT, Fraser Centrepoint Trust, Mapletree Industrial Trust, Mapletree PAC, Mapletree Logistics. Now, all these REITs essentially that were highlighted and shared with participants, investors in our GCP Global Quarterly REITs classes are up by a fantastic 17-18% on an average in the course of the last 4 months. A very good, fantastic return, not counting even the dividends that are going to come when they announce the first set of results in 2 weeks' time, or rather in 1 week's time, when the first REIT starts to report. Now, the second table, ladies and gentlemen, actually shows you the other 10 REITs, which we reckon, would be more like a diamond REITs. That means these are the ones to behold, and these are the ones that will stand you steadfast in your portfolio. But nonetheless, remember, in an up interest rate cycle, REITs are basically instruments for trading, not so much about a long-term purpose. Now, within the portfolio, ladies and gentlemen, you can see that from the low that the REITs market hit on the 26th of October, right up to last Friday prices, you can see the best REIT. So, ladies and gentlemen, in the table, you see that the best performing REITs essentially was United Hampshire in this rebound from the low from 26th of October. You can see that United Hampshire actually jumped from 37.5 cents right up to 51 cents, or for a fantastic return of 36% over a course of just 4 months. And guess what? If you have been a student of GCP Global, this next picture shows you that you were told about it. You actually met the management of United Hampshire As you can see from the picture over there, we had a fantastic dinner. We had fantastic wine. We had a very good preview of what United Hampshire was doing at the dinner with the CEO, Mr. Gerard Green, and the head of IR, Ms. Wong Siu Liu. GCP Global highlighted to our GCP Global investors who are mainly high net worth individuals and family offices that want. United Hampshire is different from the other three US office REITs. That means the likes of Manulife REIT, which have warned about, Prime REIT, which have warned about, and three Capital Oak REITs. Very different, even though they are US market. You notice that to the area that United Hampshire actually operates in, that strip malls are doing very well in terms of the asset class. In fact, well, the third best performing REIT, ladies and gentlemen, from the table you can see is Lendlease Global REIT. It is up 14 cents or 29%, from the lows that we saw when the market hit on 26th of October. And this is a picture of our latest dinner or lunch with the Lendlease CEO, Mr. Kelvin Chow, and his head of IR, Ms. Lee Bee Lind, in the low ones in September 2023. Now you notice that the misnomer and poor understanding of investors at large on Lendlease during September that sent its share price down, was one, the fact that essentially they would be having some liquidity problem because the gearing went above 40%. But we assured our GCP Global Investor students that one, Lendlease are actually in the midst of actually coming up with a proposal to actually streamline its operations for its long state assets, that is the Sky communication services for the Italian asset. And true enough, 3 months later, they actually announced that the portfolio rejuvenation and division is such that the Lendlease are in a position to let out excess building space. And true enough, this provided to be the linchpin of the recovery in the share prices. So once again, ladies and gentlemen, the understanding REITs is key to understand and very important to understand, why certain REITs perform, why certain REITs don't perform. And you notice that GCP Global, we have a history of actually highlighting the good REITs. Now you can see that in the Taobao interview that we had, on winning REITs, we talk about the likes of Ascendus REIT, K REIT, CDL Hotel Trust. We talk about Lendlease REIT that's mentioned in Chinese in there, in the two boxes that is actually enumerated in orange, Ascendus REIT, and a few others, FCT, right? So if you want to actually have a preview and knowledge of these REITs that we like and dislike way in advance, do join us for our class on the 23rd of March. Now, before we move on to the Dud Reits, one way, ladies and gentlemen, of preparing yourself to actually put yourself in a great mental state to identify diamond REITs where year in, year out, cycle after cycle is to do this exercise. I basically do this on a regular basis. I certainly hope that you can actually put in that for yourself, because one thing for sure is that you have a confident and great body with great muscles. You notice that puts you in a position to have a calm mind. And with a calm mind, you're able to actually then select the good and the best of class REITs for your portfolio in picking diamonds and separating diamonds from the Dud REITs. Take a look at this. So ladies and gentlemen, if you want to continue to find diamonds in the rough in real estate investment trusts, or diamonds, or potential diamonds, then I would suggest that you do what I do. Do the diamond push-up. Well, the diamond push-up is just simply the push-up, but it's very narrow, okay? And make sure that your hand goes all the way to the ground. Now, let's do a couple of this to see what I meant. So to see what I meant. The diamond push-up, ladies and gentlemen. 1, 2, 3, 4, 5, 6, 7, 8, push all the way to the ground. 10, all the way to the ground. Push your muscles and lightly push it up. Push your ligaments. Enjoy the diamond push-up. Great exercise. Strengthen your mind. The trends of real estate investment trusts. One of the key concepts about understanding how to make millions in real estate investment trusts is this. When I wrote my book, Making Your Millions in Real Estate Investment Trusts, 6 years ago, as well as the Chinese version, 公寓房地产投资信托, which is a bestseller in China and the US, is this. Now, to be able to actually don't spend too much of our time in actually buying the good REITs and avoiding the duds is actually more than half the battle won. Let me explain. Now, according to the Oxford Dictionary, yes, see that, you know, um, the meaning of a dud, if it's actually a noun, is a thing or a reed that fails to work properly or otherwise unsatisfactory or worthless. Okay, so yes, if these REITs have lost great value for you, be it at IPO level, be it at the price that you bought, be it in the down cycle that you saw just in the last 21 months, you notice that that will qualify like a dud. Yes? No? Well, you be the judge. If it's an adjective, the meaning of a read is of a dud is not working or meeting standards. That's faulty. So, of course, if you actually invest in a REIT to earn steady income and it fail to actually deliver that, instead it will wreck you in terms of capital losses. Is it therefore a dud? Well, you decide. And let's look at basically the worst performing REITs in this uh, interest rates upcycle, which lasted 21 months, you can see that you can, and it will come as a shock to you, ladies and gentlemen, if you look at the prices before the Fed increased interest rates on 17th of March last year, or rather 2022, right up to the prices that you have. That's on Friday last. You notice that you can and have lost in terms of your capital loss, 88% in Manulife. Livermore, 75%. Prime US REIT, 71%. Elite Commercial REIT, which just raised its, went onto the market and raised more money, 60%. Capital Oat, 51%. Digital Core, 43%. You can see in this table, ladies and gentlemen, these are already the dud REITs that those that I've mentioned, in our previous videos as well as our press interview. Now we can see once again the other thing that we've mentioned in our media interview is that almost all of these REITs are foreign REITs. Yes, with the exception of OUE commercial REIT, all of them have assets that are overseas. Right. So essentially, one of the REIT, well, in a portfolio, as we have mentioned and guided previously, you notice is Cromwell. But when we met up with the CEO, Mr. Simon Garing, and its head, its COO and head of IR, Ms. Eleanor Arabat Diva, on Wednesday, we actually discovered, to the contrary, that there's actually some excellent possible value, in Cromwell. Let me emphasize its possible value because of a couple of long-term projects which we'll study in detail, and before that, and we have further inkling of that, we will then share with you in further videos on Cromwell REIT, or more so in our class on 23rd March. Now, going ahead, ladies and gentlemen, for the rest of this month as well as this quarter, before our next class come in and into the corporate results, what can you expect from REITs? Now, if I may, I just want to share with you in our recent Business Times interview which REITs for 2024. Now, we actually like REITs that actually took the downtime in the last 2 years to do asset enhancement initiative. And because this asset enhancement initiatives, which reap a return between 7 to 12%, will kick in 2025. This will also save, those REITs that basically had to undergo organic acquisitions, to actually enhance their portfolio. So in our previous videos, we have mentioned that this REITs with strong AEI, two, with not too demanding dividend yield, three, interest of shareholder value, these are the REITs to look for in 2024. Once again, have a happy weekend. And once again, do try your diamond push-up. And if you like what you see week in week out, do actually like us, give us a subscribe, give us some love, because each video takes us about at least 10 hours to produce. So for the effort, and if you like this kind of excellent videos that we do in that for you, please subscribe, tell your friends, and give us some love by subscribing and turn on the notification button so that you will be notified when our next video comes out week in, week out. Cheers, and have a good one and a profitable